Hello and welcome to this special series brought to you by Bombay Stock Exchange Investor Protection Fund and the Money Mile. Joining me today is one of India's best known financial planners, Shweta Jain. Thank you very much, Shweta. It's always a pleasure talking to you. Shweta, when it comes to risk, we as a society seem to be a very risk-averse society. And I'm sure that when the markets tanked the way they did a few months ago, you probably were flooded with phone calls that what's going to happen to my money, etc., etc. How do you handle risk in investing? What would be your advice?
So risk-averse society, definitely. I think risk-averseness is in our nature as human beings. I think that's how we survived and thrived. But in investments, we underestimate some of these risks. For example, when it comes to, say, FDs, we underestimate the risks that are associated with it, or we kind of just ignore, because if you actually see returns, post-inflation, post-tax, you end up with negative returns. Which a lot of us don't even think about. If you look at equity, the risk is mitigated by these two things, right? If you give it time, and if you diversify your portfolio well enough. So while in the short term you could see risk in equity, over a long period you actually see that you're benefited by investing in equity. So we tend to look at the short term benefit more than long term benefits. So I think that is one of the reasons why we as a society sort of become very risk averse or are under invested in equity. If you see even gold, for example, there have been years when gold has given negative returns, but we've not gone and beaten down the asset class, saying, gold is not a good asset class. We've said, gold is down, so let's buy. But when it comes to equity, we are completely against that sort of notion. In March, when we saw all of these changes, the drastic falls across the world, not just in India, a lot of calls everywhere when you're seeing your money fall from, say, 100 rupees to 70 rupees. Of course there's panic, but when you're seeing that you don't need this money, just one question I think when we asked clients, that sort of clarified for them as well. The only question I would ask is, do you need this money today? And they would be like, no, I don't need it today. So I would be like, when do you need it? We said, we discussed this. You said you don't need it for 5 years, 10 years, 15 years, whatever the time horizon we discussed. And they said, yes, I still stand by that. So I said, then let's invest some more money. It's available for cheaper. You invested it when the cost was 100. Today cost is 70. Let's invest more. And sort of talk about it like the big Indian sale happening. And people actually were more mature this time around, I think. And accepted that they can invest in times like this and that there is panic in the market. I think it also made them look a little smarter 2 months down the line when they sort of bragged about it and said, you know what, I invested when the markets fell. It didn't matter that they didn't say how much they invested. If we had said, say, invest 100 rupees, they would still go invest only 20 rupees, but still that's fine. It was a feel-good factor as well. So I think it's also how you manage emotions during times of panic, more than greed, but definitely in times of panic, how you manage these emotions, what actions you take, because being humans, I think some action to take when things are going wrong is inherent and it's important for us. So taking the right action definitely is more important at that time.
Thank you very much, Shweta, for joining me here on the Money Mile and sharing your thoughts on this very important series where we seek to educate investors about how they can go about their investing behavior. Thank you very much.
Thank you, Vivek.